Time for your RX for Forex. The gentleman that I'm about to transition this call to, he has his PhD in finance and economics. He has over 26 years experience. We're talking about someone that is going to bring you your RX for 4X. I'm going to turn this call over to none other than Dr. Craig Bythewood. Dr. Bythewood, are you on the line?
Yes, I am, Ms. Dyer. Thank you very much. I hope everyone's having a wonderful Tuesday. Welcome to a talk with the finance doctor. Thank you, Ms. Tasha M. Dyer, the trade whisperer. You have to whisper it, the trade whisperer, for everything that you do for our BYOB movement. I appreciate it. Thank you very much, Ms. Thompson. So, on tonight's Talk with the Finance Doctor, we're going to have a special subject that will be discussed, and that will be stock splits. But before we get into stock splits, let me first properly introduce myself and this call to our 111ers. So this is a talk with the Finance Doctor rather than a talk from the Finance Doctor, because we want to make sure that this is an intimate conversation. We chose that prepositional phrase on purpose because this is the only forum where you can get around this fact that personal finance is the only area of our society where the individuals who teach you about the personal financial products just happen to be the same individuals that sell them. So in a conversation about insurance, for example, that conversation is going to be beneficial to the company. But these conversations that we have here can be beneficial to your household. So as I've been saying for 26 years, I am not anti-institution, I'm pro-household. So this is a conversation, this is an opportunity for you to have a conversation with someone who's just like you, but just happens to have been exposed to this material and exposed to this information, having my doctorate in finance and economics, and being someone who has always wanted to help, someone who naturally and organically has a servant heart. You're here to take advantage of this. So welcome those of you that are business partners. Welcome those of you that are future business partners. Only two types of people on this call, and I just stated both of them. So with that in mind, let's jump right into the material. Now, if you ever get a personal email from me, you'll see at the bottom two Bythewoodisms. The first Bythewoodism is worry is interest paid on a debt you may never owe. That stands for it by itself. But the one that's relevant to this conversation is the second Bythewoodism, which says, if you know what you are doing, you will always have a job. If you know why you are doing it, you will always be the boss. So we're going to approach this concept of stock splits, and I'm going to answer it for you thoroughly, but I want to make sure we understand why it is important. Why do we care? Why do we care what a stock split is? So let's start by saying this. One of the things that Ms. Dyer does in the many weapons that she provides us is she allows us the opportunity to also trade this foreign exchange scenario on stocks. So we can ride the wave on the stocks rather than having to own the stock. And she oftentimes will give us recommendations on securities that she expects to have a big move. Well, recently she mentioned Tesla. And she knew that Tesla was going to have a big move because Tesla was about to split their stock. And someone asked in the chat, what does it mean for there to be a stock price? Excuse me, a stock split, and a couple other little questions beyond that. And then Ms. Dyer said, there it is again. The collective consciousness, which says 111ers. The Bible calls it where two or more shall gather. The quantum physician description of it is whenever energies align, whenever they're in the same place, whenever they're together, the energies match up. There's a reason why you're on this call and not somewhere else. There's a reason why you're the one on this call and not someone else. So whenever the energies come together like this, collectively, they're vibrating on the same frequency. It's law. It's the only way they can be together. Have you ever walked into a room and just felt like you didn't belong and immediately changed it and walked out of the room? Frequency. Have you ever been in a room and somebody who you know doesn't vibrate like you walks in the room and they immediately turn around? The frequencies don't vibrate. So bottom line is collective consciousness means that these energies vibrate. When one person has a thought, somebody else has the same thought. So Ms. Dyer, when she saw the chat question, said, I was going to bring up that very question tonight on what is stock splits. Now, I do want to do a little bit of fussing. And you know, fussing to me is just really giving you an opportunity for expansion. We're just calling it fussing out of sarcastic love. But the person that asked the question said after that, I apologize for asking the question. Come on. Never apologize for asking the question. That's how we grow. That's how we expand. That's why we had another example of the collective consciousness. When you should apologize is when you don't ask the question. Because when you don't ask the question, guess what you have decided to do? Stay the same. Do not apologize in the Be Your Own Bank movement for asking a question. Apologize when you don't ask a question, because then there's an opportunity for growth and expansion that you decide to skip over. So thank you. I believe it was Miss Brandy Williams. Thank you for asking that question. I really hope she's on this call. So in order for me to explain to you about stock splits, I'm going to have to make sure you understand stocks. Now, I talk about this all the time. Ms. Dyer very intelligently and very wisely makes you do two things before we look at a single chart. First, say your affirmations, because that same book I referenced before says, I am that I am. So that means whatever comes on the other side that I am, that's what you're going to be. I am tired. I am hungry. I am sad. You ever notice how people do this a lot? I'm not good at it. I do not allow my children to use that phrase. I'm not good at it. I'm not good at. Because whatever you put on the other side of that I'm not good at, that will be your reality. So I'm saying all that to say this. The first thing she makes us do is talk about our affirmations. See who we are. We are what? We are master traders. The second thing she does is go to the news. So if you and I, some of us who've had experience in other academic areas, are now being asked to go to the news and understand a world of macroeconomics without training, we have to take advantage of these opportunities, like on a Talk with the Finance Doctor, to make sure that we're up on it, to make sure that we understand the way it works, to understand the actual phrases. So this is important, because if we understand the way the stock market works, because that is really the infrastructure on why the financial markets exist. The first financial market was, let me say that again. The first non-physical financial market. The first non-physical market. The non-physical financial market was stocks. So although we're focusing on Forex and indices and metals, we still need to understand the stock market, because it is the infrastructure for why we get to do what we get to do. We're master traders because the stock market exists. Plus, after you have used this skill set to build the wealth and abundance that Ms. Dyer was talking about, what happens when you own your own company? What happens when you issue your own shares? We have to understand stocks. So even though we don't have to own them because we're riding the wave, we still have many reasons why we should understand. So that second Bipedism says, if you know what you're doing, you will always have a job. If you know why you're doing it, you will always be the boss. If you know what you're doing, you always have a job. If you think you get his own Bipedism right, let's start over. If you know what you're doing, you will always have a job. If you know why you're doing it, you will always be the boss. So we need to understand why. Now let me tell you the way I expect this to go down. It's 10:09. I will have finished breaking down the stock market for you at 10:24. At 10:24, that will give us a good 6 minutes for you to ask any questions you have about anything that we've talked about. So in order for us to understand stock splits, we first have to understand why stocks exist. So you're going to teach me about how a stock splits when I'm not exactly 100% sure, A, what a stock is, and B, how it's utilized. Well, by 10:24, you'll understand. Actually, by 10, 20, you'll understand that. And then the next 4 minutes will be just me explaining stock splits. Now, here's how it goes. 1890s, Industrial Revolution. That's big because prior to that, everything was about animals and land, agriculture. So now we've got these big companies. This Industrial Revolution is the first time that companies were making money on industry, on technology, steam engine, all that kind of stuff. So we decided that these large companies, we called them conglomerates back then, these large companies, they were in a position where they knew that they could raise capital very easily. And as the technology was going really fast, for example, you've got a steam engine, and now that steam engine is going to have new technology. And when the technology changes, you now have to buy new parts for the steam engine. So these early industrial companies needed ways to raise capital quickly. So what they did was they recognized that any company has two ways that they can raise capital. Again, we're here to learn trading. But once we learn the trading and execute the skill, these are things we're going to have to do on our own. Be your own bank. You're going to be your own bank. You're going to be your own company. The dreams you've had all your life, you're going to be able to execute them. So this is an important conversation. How does capital work and flow in our society? Now, when a company decides that they'd like to do whatever it is they're going to do, there are two places they can get money. There are two places they can get money. There are only two places they can get money. They can either borrow it or use their own. How simple is that? There are only two places that a company can get money. They can either borrow it or get their own. I like to use this analogy, own. Hey, where'd you get that money from? I borrowed it. Where'd you get that money from? It's mine. Own. Those are the two choices. I've got a perfect example for you. I was traveling about 6 months ago. I was at the airport and I had to pay for my luggage. So I pulled the cash out of my pocket and they said, no, sir, we don't take cash. What am I going to do? So the luggage costs this amount of money. What is the asset that I'm about to purchase? I'm about to purchase the ability to be able to check my luggage. Now, where am I going to get this money from? Well, I can only get it from two places, according to Dr. Bythwood on Talk with the Finance Doctor. I can either owe it or own it, own it. So I took a credit card out of my wallet that had about half of the amount for the luggage. So I put it on there. Then I took a Cash App card and used that. Well, that's my money, right? Then I took a Cash App card and used it for the remainder. Do you see what I just did? I had an asset and I used two forms of capital to pay for it. One was a credit card, which meant I borrowed the money, and the other was my own money because it was on my card. That's the way capital markets work. When companies make the decision to get capital, they only have two choices: borrow it or use their own. Borrow it or use their own. Borrow it or use their own. Now, here's how it works. Companies can, if they choose to borrow a percentage of their money, what do you mean by percentage? Well, let's say they're going to raise $100,000. Let's say they need $100,000 to do whatever they're going to do. So they decide that they're going to borrow 40% of it. They can go to a bank and borrow $40,000, but that's not always efficient. So what they'll do is they'll do this. The company will say, hey, we're going to go to the financial market, and instead of raising $40,000, we're going to find 40 people who will be willing to give us $1,000. Let me say that again. This is not math, this is concept. So instead of going to the bank, raising $40,000, having to give collateral, having to fill out this paper, you know how banks are, be your own bank. So instead of dealing with $40,000 bank loan, they're going to find 40 people that'll be willing to loan them $1,000. Now here's how it works. When the investors loan the company $1,000, the company now has the right to pay them interest and pay them their money back. Okay? Now watch this. If the company decides not to pay you, what are you going to do? I'm going to sue them. No, you're not. Because lawyers start at $2,500. You only borrowed $1,000. You only lent them $1,000. So when companies or individuals lend money to the company has to pay them back. In fact, they're bonded by law to pay them back. If you know what you're doing, you will always have a job. If you know why you're doing it, you will always be the boss. That's why a bond is called a bond. It's just a loan. It's just a company making a decision to do the same thing I did at the counter. I took the credit card out and borrowed the money to pay for part of the luggage. So the company's taking bonds out and using it to pay for part of their stuff. So the reason why the bond market is the bond market is simply because it represents loans between companies and investors. It represents loans between companies and investors. I'm almost finished. So the company decides to raise money in the bond market by borrowing money from individual bondholders. That's why it's called a bond. Now, on the other side, remember I took that Cash App card, right? That's my money. I put the money on Cash App. That's my money. So the company can use their savings. They can use the money that they have. They can do that. But in the 1890s, when these companies became technologically sensitive and they decided they wanted to raise money quickly, what they did was came up with this idea. Why don't we take ownership shares? Why don't we take all of the money we're trying to raise, divide it into little shares, and then sell it to the investing public? And then say, hey, check this out. I'll give you part ownership in my firm if you buy this little piece of paper that I'm calling a stock. And if you buy this little piece of paper that I'm calling a stock, here's what I'll do for you. I'm going to show you due diligence. I'm going to make good decisions. I'm going to let the market love what I'm doing, and then the stock price will go up. And guess what you get to do? You get to sell the stock for more than you paid for it. That's how the stock market was born. If you know what you're doing, you will always have a job. If you know why you're doing it, you will always be the boss. So all the company is doing is making a decision to raise capital by selling ownership shares. That's it. That's what a stock is. Now, watch this. There's a very interesting situation here, because when I'm issuing shares, what does that mean? That means that I'm making a decision to take these little pieces of paper, these little ownership shares, and give them to people and say, hey, buy this. And that's how I raise capital. The first time I do it, it's the initial time I did it, and I'm making my stock available to the public, initial public offering, IPO. Anytime I do it after that, it's just a public offering. So hear me. Every time the stock is issued, every time the company decides to issue the stock, think about the deal that we're giving them. I'm saying to you this: you buy this share, okay? You buy this share, and I'm going to take some action, which is going to make the stock price go up. That makes sense, right? That's a pretty good deal. I'm saying to you, you purchase this share, stock price goes up, you can sell it. Now think about this. If the individuals that are giving the money to the company in order to be able to purchase these shares, if they know that they can now ride the market up in order to sell this, the higher the stock price is, the less they'll want to buy it. I just said something, let me do it again. If the company or the individuals that buy this little piece of paper, this share, this stock certificate, if they know that the way they get paid is when it rises in value, they can increase it. The higher the value, the less they're going to want to buy it. I want it to go up. What do they say? What's the rule? Buy low, sell high. Buy low, sell high. Tangent to my tangent. The other day I was talking to my daughter, and they were having a little argument with each other. And I suggested that they pause and go and write in their appreciation journal. And I do that because I know that it is impossible to be appreciative and angry at the same time. So if they pause what they're doing and they write in their appreciation journal, the energy will shift, and at that moment they will feel grateful. I'm going to make you write in your conceptual gratitude journal right now. So 6 months ago, I had a conversation with a fraternity brother of mine. And I explained to the fraternity brother what this whole situation was about. In fact, if I could really just be transparent with you, I actually invited them to an economic empowerment call. And so the fraternity brother said this. The fraternity brother said, well, I hear what you're doing, Craig. You know, I know you didn't call me Dr. B. It's okay. I understand what you're doing. I get it. But I'm investing in Tesla. And I'm up 300% on Tesla. And I feel like that's the best move for me. So I asked the question to the fraternity brother, how long have you had Tesla? And the fraternity brother said, for 3 years. So I want you to think about that. This person has access to the same information we have about Tesla. But this person invested in Tesla, and 3 years later, it's up 300%, but they haven't had the opportunity to make the 300% because when you own a stock, you have to sell it in order to make money. You buy it here and you sell it there, and that's how you make money. But as we write in our conceptual appreciation journal, you and I can accomplish the same thing, but get paid immediately. If he bought Tesla and went up 300%, that means we can take a position on Tesla, go up 300%, make the same profit, and earn it over and over and over again. I'm just saying. I just wanted you to recognize where you are right now as we have this conversation. So look at this dilemma that I have as a company. I'm the company that's issuing the shares. Now watch this. I want to issue this share at a certain price so the individuals would feel comfortable that it is going to rise in value because that's how they make money. And if my stock price is really high, they'll start to doubt whether or not it'll be able to go any higher. So this is what happens. The experts that give companies like Tesla the direction will tell them an acceptable range for what they should issue a share. Let's say, just for the sake of argument, the acceptable range for a particular stock is $50. People feel comfortable about a $50 stock. So then you own it, you issue it at 50. So you find 1 million people to do that at $50, you just made $50 million. Let me do that again. You find 1 million people willing to pay $50 for your stock, you just raised $50 million. Now watch this. The stock price begins to go up. Now it's 500. Everybody's happy. I'm happy because I bought it at 50, now it's 500, and I just cashed in my stock. So now the company decides they'd like to expand. They'd like to be in 80 countries instead of 40. So they decide to issue again. But watch this. The stock is $500. If the stock is $500, who's going to buy a $500 stock? Who's going to think that a $500 stock is going to go up? Remember, the acceptable range was 50, and it went from 50 all the way to 500. So guess what the company does? The company decides to take the stock and split it. Now that you split it, it's going to go back down to 50. And guess what? A whole nother 1 million people will purchase the stock at 50. And then it's going to go up to 500 again. It's more efficient to go from 50 to 500 than it is to go from 500 to 1,000. So splitting a stock is simply a way for, you thought it was about you? You thought the stock split was about you, the investor? It's never about you. It's always about the company. That's why we want to be our own bank. That's why we want to be our own organization. That's why we want to be our own institution. So the stock split simply means that every person who has one stock, let's make the math a little bit easier. Let's say that it started at 50 and it went to $100. So if they do a 2-for-1 split, that now means that each person now has 2 shares. So you had 1 share at 100, but now you have 2 shares at 50. But it's not about you, the shareholder, it's about the company. It's about bringing my stock down to an acceptable range so that when I issue the stocks, now I'll be able to do it. So Tesla splitting simply means that it had gone to a range where it was too high to be able to issue it, so they split it so they can issue it at a more affordable range. Guess what? It's 1024. Questions, comments, testimonies on what a stock split is and any of the other dimensions of stock that we describe. Questions, comments, testimonies. Questions, comments. I did this on purpose. I wanted to make sure we had enough time to really address this, to really ask the questions, to understand the way this stock market works, because it undergirds everything we do as Forex traders. Questions, comments, testimonies. Thank you very much, Ms. Money King. Questions, comments, testimonies. Yes.
Dr. Bythewood, I just want to thank you again. I've been doing a little thinking. I've been privileged to live long enough. I purchased war bonds and war stamps for World War II. That's all I knew about finances. I went to work for the telephone company at graduation. I had stock in the telephone company. I went through splits, just as you're saying, without an understanding of what was going on or why. And we also, there were some other things that you talked about with the stock that you made me understand. Here at 83 years young, I get to understand not just what, but why. And you're talking about a gratitude journal. I've got a gratitude journal that's as long as my right arm. And I'm so grateful for this. I just pray that all of us understand what we have. And we're listening to you with our third ear, with the ear of our heart, so that we get full understanding. Thank you so, so much for all that you sacrifice and for your willingness, you and all three of you, pouring your heart out and pouring yourself into us so that we can become everything God wants us to be. Thank you.
You are very welcome, Ms. Brownlee. Thank you so much for saying that. Questions, comments, testimonies about stocks/stock splits?
Doctor?
Yes, ma'am.
Thank
Evans,
you.
what can I do for you?
Yeah, thank you so much for breaking that down. There's so many things that I'm learning about the stock market, and my curiosity runs crazy. So in all of the things that you've been teaching, I opened up a brokerage account with TD Ameritrade also, and I did some traditional stocks, and I have like a little paper money account with them. And you know, they start you out at $200,000. And so me playing with the paper money, I bought a whole bunch of Apple, like 500 shares and 500 shares of Tesla. And with that paper money account, when the stock split, I lost over $100,000 playing with it. So I was like, this is no joke, nothing to be played with. And if this was your real money, you'll be sitting somewhere crying. So thank you so much for explaining this to us so that we'll have an understanding, because when you start trading your real money, you want to know what you're doing.
So thank you for saying that. I really appreciate that. And I'm glad you brought this up, because this allows us to be able to apply this to a little bit greater extent. So the stock splits. So from a numerical perspective, you may have less, but you now have a higher opportunity for growth. The growth rate has substantially increased because before the split, the price of the stock was so high that there was a very small opportunity for it to grow. The growth rate may have only been this much. Think about what Ms. Dyer said during the training. Look, somebody said, well, how many pips can it go during the hour? And she said, it's about support and resistance. And she showed this one chart where the candle was close to the resistance. And she said, it's only gonna go as far up as that. Well, that's where your stock was. Your stock was so close to the resistance that it only had a little bit to grow. But then when it splits, now it's way down here. And it has the opportunity to be able to go back up. So that's another application for this, that the split may seem like it's less, from a numerical perspective initially, but you have the opportunity to ride it up to a greater extent. Does that make sense? Ms. Evans, I want to make sure that makes sense.
Yes, sir. Thank you.
You're very welcome. Questions, comments, testimonies about stock splits and or stock?
Dr. Bythewood.
Yes.
Gerald D. Rogers here. Question. Can you, with the analogy that you just gave, stock split, price decrease, the benefit that we have from a trading perspective, and then secondly, why this movement is so of a necessity, knowing it, and that even in the scenario that Ms. Evans just made mention of, $200,000 to be able to purchase 500 shares, why this is a unique skill set possessed, because in most instances, individuals who really want to take advantage of the stock market has to have a lot more liquidity.
Right. So thank you for bringing it up, Mr. Rogers. If he really cared about me, he'd send me these questions ahead of time so I can seem more intelligent. But no, he always asks me on the fly. So basically, if you think about the analogy we gave, I'm joking, the analogy that we just used, this is the amount of the stock right now. And I use the analogy of it going from here to there. What I may not have specifically said, thinking that you would just conjecture it, you've got to pay for this stock. And when you pay for this stock, guess what? That money is no longer in your possession. That money is tied up. So you know how we try to figure out where your TP is and where your take profit is? I take profits happen the same day. It could be or the same week. Their take profit can be months away. So that money is tied up as you're waiting on it to go up. But we have the opportunity to not have to pay for the money, but for the stock, but simply decide how much we're going to put on this trade. And then as it goes to a certain point, we can liquidate the transaction right then on the spot. And this is the perfect part, then we can do it again. Then we can do it again. And then we can do it again. What? Something happened, now it's going down. And then we can do it again. And we can do it again. So the individual that buys the individual stock only has the opportunity to make money when it goes up. And that money is tied up as it travels. Whereas we are simply taking a position on the same security, and we can ride that wave up and we can ride that wave down, never losing our liquidity. Never losing our liquidity. And think about something. There's no stop loss in the stock market, because technically there is, but bottom line is you just want it to go up. So you're just gonna wait until it goes up, and your money is tied up while you're waiting. So we literally have an opportunity to go beyond the market of owning a physical asset and tying our money up and being liquid with each movement of the stock. Thank you for asking that question. I think that really solidifies this concept and the difference between this conversation and the vehicle that we have access to, which is why I use the gratitude journal example. Questions, comments, testimonies?
Good evening, Mr. Bythewood. I do have a question. I'm not sure if it's going to be a little off, but as far as stocks, when you have I don't know how it affects, like if you have an ETF or options, does that matter? Based upon the concept that you're talking about when stocks split?
So ETF is an exchange traded fund, and an option is a derivative. We had a 3-part conversation on options for the new people that you'll find on our playlist. Now, it does change. It is different, because the option itself, first of all, exchange traded fund is a conglomeration, so it's a totally different situation. But the option itself is based on a particular exercise price of the stock. So the moment that the stock splits, that option is null and void now, because it has to be a new exercise price, because the market value has just changed. So for the most part, what happens is that options are short term. They're normally 3 months or less. So most times they know that there's going to be a split. And by the time that happens, the option is not going to be an issue. Now we'll add this to it. Once you have a situation where the stock splits, you now have a more liquid stock market. So technically, you can make more money on options than you can once it splits than you could before it splits, simply because, again, the trading range and liquidity is going to be wider. And the wider liquidity range, then the more you can make on an option.
Okay, thank you.
For asking that. Questions, comments, testimonies? Well, thank you everyone for your attention tonight. Thank you for that question, Ms. Williams. I'm just curious, is Ms. Williams on the call tonight? Brandy Williams? How about I just look myself?
I have a question, Dr. Bythewood. This is Tracy.
Yes.
I was looking today at something called a stash app. Do you know what that is?
I do not. Spell it for me.
Okay, it's something where it's a way where you can take an app and save $1, like you invest $1 and then no, I have to do some more investigating.
So
Sorry.
let me tell you something about the finance doctor.
Okay.
I do not know what you're talking about, and I have no idea what it is, but I believe very strongly in energy. And there are times I can drive by someone and look at the energy in the car and see what's going on. There are times people can walk into a restaurant and I can tell the kind of energy that they have. So the energy that came off of this thing I've never heard of, it feels small. It feels much smaller than what we're doing. So I don't know what it is, but it
Okay.
just feels like wealth and abundance. It feels small time. And you and I.
Okay. So done. Okay, thank you.
Questions, comments, testimonies?
Yeah, how you doing, Mr. Dr. Bythewood?
Yes, sir. What can I do for you, Mr. Harris?
Yes, sir. I was saying what you were saying about the like stocks and the market. I'm feeling like you only win in the stocks when it go up. That's what I'm getting at. Like you only win when the stock's going up, but in the market you can win going up or down.
Correct. Now, technically, I left a part off because you can do what's called shorting a stock, which means you can make money when it goes down. They just don't advertise that. They don't tell you about that because the institution only wants you making money when it goes up. And I'll just give you a quick example why. What's the rule? Buy low, sell high. Buy low, sell high. If you're in high school and there's a girl or boy that you really like, you're not going to get that person to your best friend. You're going to date them yourself. So if it's buy low, sell high, and they buy low and then they sell high, who are they going to sell it to? They're going to sell it to us. So if it's a good stock, they're not going to tell you about it. They're going to date it themselves. The number one institutional investor are insurance companies. Number two institutional investors are banks. So banks and insurance companies are the same companies right now. So my point simply is this: if they're buying low and selling high, they're going to pick the stock at a good place. Then when it's time to sell it, they're going to sell it to us. So they have an incentive to make us think that that's the only way you can make money is to when it goes up, because that helps them to have an active market for their trades. Does that make sense?
Yes, sir.
Boom. Was there another part of your question, Mr. Harris?
No, sir. That's where I was getting at. That's all.
Okay, last chance. Questions, comments, testimonies, because it's about time for me to go to the club. Questions, comments, testimonies. I know I'm going to bed. Questions, comments, testimonies. Okay, I really would like to thank everyone for your compliments, for really dialing in. I can feel you guys really absorbing this information. And it's interesting that I get that a lot when I talk about this, that these are things that people have heard about their whole life, but never thought about it. Because we live in a world where people want to tell you what it is, It's up to us to really get into the why. So some of these questions some of these topics we're discussing, they hopefully will be a bridge into you thinking about other things that you only have a surface knowledge of, and you bring them to this environment. That's really how we grow and expand. So I appreciate that. So let's close in prayer, please. Heavenly Father, thank you for a talk with the finance doctor tonight. Thank you for this conversation. Thank you for the comprehension. Thank you for the compliments. Thank you for the collectiveness. Thank you for the cohesion. Thank you for all of these great seeds of positivity. So we ask at this moment that everyone listening to my voice will have a wonderful evening, will wake up refreshed and ready to go and have another productive, abundant day. Thank you for the BYOB movement. Thank you for all of the movers in the movement. We are thankful, we are appreciative, and we are grateful. Amen. Thank you very much, everybody. Have a great evening.